It's like buying a house. If you bought a house that for $100, but they left a safe with $10 of gold in the living room, well, you bought that house really for $90 because you can take that gold and safe and sell it on, whatever. If you bought that house, a month later after you own it, there's a hole in the roof and you got to get a new roof that costs you $10. Well, you didn't buy it for $100, you bought it for $110. And the businesses are the same. So my stock selection process is pretty simple, actually. And again, it took me 3 or 4 years to figure this out. So after I started my own fund, so it took a while, but it's pretty simple, really. It's the balance sheet, it's the valuation, and then you have to have one of the two other things: either a good business, which is high return on capital, or a good management team, which it means that they know they have to maximize value. So let's say if you're not just U-Haul, but one of these major self-stores, like public storage, and you have a bunch of people building near you, like a bunch of mom and pops who are not particularly well capitalized, well, you just lower your prices for a quarter or two until they default on their debt and you take over that facility. It's much easier to be free and happy if you enjoy leftovers and used cars versus eating at fancy restaurants and buying six-figure cars.
My home library includes many investment books, and I've read most of them. However, one of my biggest aha moments in investing happened when about a decade ago, I was watching a YouTube video with an investor, James Pan, sharing his investment process with a group of students. Basically, he suggested a back-of-an-envelope screen for valuation. Start with the stock price, reduce it by the amount of balance sheet cash per share, and reduce it further by the amount of earnings for the next year or two, also per share. Suddenly, the price and earnings multiple are very different, showing us whether the company is cheap or not. I'm really oversimplifying, and there are many nuances, but you get the idea. Years later, I invited James to my podcast to discuss investing in more granular fashion, and this episode is a result of that conversation. But before we start, don't forget to subscribe to the channel. And now we start.
I guess the most important question is, why are you awake at 4 a.m.?
I don't know what time I'm going to wake up. I do know that I generally go to bed at 9 and 10, and I sometimes I wake up early, like at 3, and just feel like reading stuff and things like that. Usually, I'm definitely up by 5 a.m. To read. It's a lot of quiet time, but I don't want to overimpress people. I usually take a nap at 1, and usually knock off work by then too. Well, probably I really knock off work around 11 a.m. Don't tell the stocks that. But, in this business, you're always consuming information. You're always thinking about your positions or new positions or just businesses in general. Like, why did this business succeed? Why did this business fail? You're always listening to podcasts or, listening to news articles from the Wall Street Journal or the FT or whatever your favorite source of information. And the new technology is great in terms of like being able to consume information and multitask. Like you can do chores, you can do your exercise, and it's much more productive now. So you can, defeat two things: absorbing information and getting in a little bit better shape, or less worse shape in my condition, in my situation. So when I wake up and I just try to read the day's newspaper and stuff like that. So
you're on a family office now, right? How did you what was your career path? And
I started in Wall Street actually in 1992. I was a student in New York at Columbia, and I always knew I wanted to be a value investor. So, and that was not easy back in 92, especially for someone breaking in. Was transitioning in from IT to value investing. I didn't have any contacts coming into New York City at the time. So Columbia, I went to Columbia. Columbia was nice enough to drop me 3 names, alumni names, and I just cold called them. And one of them, named Emerald Partners, Don Parker, offered me an informational interview. And there I asked if anyone was looking for an internship and pitched him some of my ideas. And they took pity on me and gave me a desk out in the office. His partner at the time was a young woman who was also, young women investors were very rare on Wall Street back then. Her name was Mara Buchanan at the time. You might know her married name is Meryl Whitmore, who went on to serve as a current member of the Berkshire Hathaway board, and a very noted and successful value investor. So, and from there, my first real job was to learn how to short sell. And that's where I met Bill Strong, Michael Katz, and Amit Badlani. And those guys all had various influences on me. From there, I went on to work at CP&E Partners with Jeff Hallis and Michael Lowenstein and Tom Coleman, all three extremely successful investors. And from there, in 98, I started my own firm. Luckily, I had a little bit of family capital. My family was in the government consulting business. And so they spotted me some money. And it wasn't because they thought I was a good investor or anything like that. It was just because I was their best friend or their son or their brother. And they didn't know exactly what it would turn out to be. And neither did I, to be completely honest. You don't know if you're going to be successful until well into the effort. And I was going to be a real hedge fund then, like long, short, typical hedge fund type thing. And then I began to, a couple things began to dawn on me. No one was going to trust a one-man shop. And you had to send these monthly performance numbers to all these consultants and fund of funds. And that was not my favorite activity. And so I realized relatively like within 1 or 2 years of the process that I had enough family capital in the fund that if I did well, I'm going to have a very comfortable life. And if I didn't do well, I was going to feel very guilty about taking other people's money. And so, in the first 3 years, I had really good performance because this is the late 90s, early 2000s. If you remember, there was a big bifurcation in terms of the dot-com stocks and the value stocks. So my timing was impeccable. And I really did well those first 3 or 4 years. And by the end of that period, I just said, okay, if you want to come along for the ride, there's a vehicle for you. It's a 1 in 20 vehicle. But I'm not going to market. I'm not going to send out monthly numbers. If you want to come along for the ride, you're more than welcome to. So I never really raised outside capital. And then 2011 rolled down. There was some confusion about Dodd-Frank. And at that point in time, only 6% of the capital was outside capital. And so I decided just to return to funds at that point in time, and just become a family office. There's no fees. There's no compensation. It's just my family. They come along for the ride. There's still a K1. There's no more audit. And, the expenses are split proportionally to, the partnership interests. So basically I haven't had someone else pay me a paycheck for 25 years. I haven't had any paycheck in 12 years. And, so, I just live off the gains and the dividends. Obviously there's been no interest income until this year for a long time. So that's my journey. Now, about 3 or 4 years ago, I hired my younger brother, Justin, who's, I find, very fortunate enough that he thinks like me. He's much more educated than me. He has an engineering degree and an MBA like myself, but also a law degree. So he's much more detail oriented than I am. So I'm very lucky to have that type of the person I'm working with, that someone I inherently trust. And we think in a similar manner. And I have 3 other brothers and they don't think in the same way. They're all smart. They're all very accomplished business people, accomplished in their own careers. There's a doctor. There's another brother who's very quickly rising through the government ranks, and has reached the highest levels at a relatively early age. And then there's another brother who, ran a business with 200 employees and $10-15 million in revenue for 10 years. So they're all very accomplished. It's just that in value investing, you're either wired for it or you're not. And it's just one of those strange things. It's not just genetics. It's just, some brothers are right-handed, some brothers are left-handed. It's just weird how that works out.
How do you define value investing?
Well, I know there's this debate between value and growth and stuff like that. And that's kind of, in my opinion, not really relevant. It's really just buying a security or an asset, because it doesn't just have to be stocks, that you're buying cash flow from. And it might not be cash flow for that year or the next year or 2 years from then. It could be cash flow 10 years from now. That's continuous and growing. And I'll give you an example. In 2004, I think, and I could be wrong about this, but Google went public at 75, was it 75 or $85 or something like that? And that was like a lot of splits ago. So I think at today's price, it would probably be, I don't know, $2 or $3 or something like that, for Google. And of course, in 2004, Google wasn't really making any money, and it was something most value investors weren't familiar with. They didn't understand how big the market was going to be. But imagine if you bought it back then, $2 or $3 stock price that had zero earnings for 2004 and maybe 1 or 2 cents for 2005. But you fast forward, 19 years and it has, I forgot the numbers, but it's like $15, like $10 or $15 in cash, another $10 of value of Waymo and cloud. And then it's earning, like, if you don't count the stock options, which is, your purview, and more generous in terms of free cash flow and economics, supposed to earn $8.50 next year. And you're buying that at $130. Well, you bought that claim for $2 or $3 back in 2004. If you had that type of clarity, then you could argue in 2004, you would say that's a growth stock. But if you had that clear vision back in 2004, well, it's obviously a very cheap value stock. So value investor is just buying cheap earnings. I mean, what I really do is just buy cheap earnings with a margin of safety. And my margin of safety has evolved. I mean, if you look at the traditional margin of safety that was defined in the Intelligent Investor and Securities Analysis, it was price to value, and I didn't know this when I started back in 98. It took me, 2 or 3 years of losing money before I figured it out. It's also the balance sheet. And that's something that MJ Whitman stressed in his writings, which if you can find his old letters, I encourage you to study. You always want to be the senior on the capital scale. You always want to be what we call strong money, because invariably you're buying that stock at a cheap price. That's why it's cheap. You're buying that company. It's a cheap valuation. It's a cheap valuation because they have some kind of problem. Hopefully it's a short-term problem they can get through. But you want to make sure that they have a strong balance sheet, preferably net cash. But if not net cash, that they can service the debt very easily. So you don't come out of whatever business slowdown they have with your equity side impaired, like the car companies did in 2008 when they went into bankruptcy and had to issue a lot more debt to replace the equity, or the banks did in 2008. And so that's another margin of safety. So you got the valuation, you got the balance sheet, which are key. But then you also have the business quality. Some businesses are just better than others, like MasterCard. I think McGraw-Hill somehow has the two bet. I don't own any of those companies, but McGraw-Hill obviously has one of the two of the top 5 businesses in the world. It's the index business, which they get whatever, a couple pennies every time someone trades an ETF with S&P named in it, and the ratings, the bond rating business. Those are both incredibly lucrative franchises. So one of my biggest mistakes was selling McGraw-Hill back in 2011 because I didn't understand the lawsuits, how they were going to manage them. So that kind of freaked me out. So I wish my brother Justin was working on that, and maybe he could, put a box around the risk of those lawsuits back then.
So what's your investable universe, and how do you go about finding the securities?
I have stuff in Korea that I've owned 20 years. Not because they're necessarily great businesses, but they're so cheap and I'm just too lazy to sell them. And at this point, they're traditional in some ways, not net nets, but like service companies trading at 0.1 times value with no net debt. So it's more like a really cheap call warrant. I own stuff in Mexico. I own a toll road in Mexico. I own through Fairfax, India, an airport in India. I think it's Mumbai. It's going to be one of the largest airports in terms of traffic sometime in the next 20 years. I own a Brazilian telecom company, and I own some small caps called Google, Amazon, Facebook. I heard they have a pretty good future, but that's just a hunch. I own U-Haul. I own, so that, those are the type of things I own. And I get my ideas, there's a lot of pattern recognition. You've seen these things over and over again, although they're slightly different each time. But, over 30 years, you have quite a database of companies that you like inherently, and other businesses, that doesn't take that long to say, I'm not interested in it. I've also been very fortunate enough to have a lot of mentors and friends. They share ideas with me and things of that nature. So it's from all over the place. Generally I look at the 52-week low list. I look at the Morningstar 5-star rating list. I look at the 13-week worst performing stock list. And it's like after this long in the business, you are familiar with a lot of those companies listed there, and you can make a decision whether you want to spend more time in it or not.
What do you typically look at the company, and like when your friend tells you about company X, where do you start?
Evaluation and balance sheet. Actually, just balance sheet first, right? And then, but that takes like 30 seconds to read a balance sheet. And I think Yahoo Finance does a really good job with their statistics as a first cut. The statistics tab, you look at the enterprise value. If the enterprise value is lower than the market cap, that has net cash on it, that's an indication of net cash. That's a first cut. And then, the valuation. Well, you look at the consensus, but also you comp it against other things. So if Home Depot and Lowe's, which I own neither, but they both have 10 PE, well, then does one have debt? Does one have net cash? Does one have, I'm just making these numbers up, 12% margins and the other one have 8% margins? Because if they're both 10 PE, I'd rather buy the one with 8% margin trying to get the revision to the mean. I'd rather buy the one with net cash with a stronger balance sheet because it's more margin of safety, because the housing crisis is going to hit both of them equally. And so you want the one that, has a chance to revert to the mean, but you also have to check out, historically, maybe one of them is over earning, but maybe traditionally the revision, the EBIT margin is 10%. And so maybe you can only go 8 to 10, but in general, MasterCard and Visa should have the same margins. If they don't, then why? Moody's and S&P for their ratings business should have very similar margins. Meta and Google for their advertising business should be similar margins and things like that. So you comp it against history of the company and the comparables, and also you think about it, and it's like, what is really going on here, and what should the incremental margins be? Like if you look at Amazon, well, their incremental margin on the advertising part is humongous. It has to be at least 80% EBIT margins. If it's not, then they're obviously reinvesting a lot of it in other things, because that advertising is even more targeted than Google. So, because it's something on their site that people intend to buy. That's the best type of advertising.
It's interesting you said, if there is when you compare it to margins, you would buy one with a lower margin because of reversion to the mean, because intuitively you would think that the one with the higher margin is probably better run business and probably should be.
Well, what I think happens is that someone else will look at that and they'll be taken over. So usually, my stock selection process is pretty simple, actually. And again, it took me 3 or 4 years to figure this out. So after I started my own fund, so it took a while, but it's pretty simple, really. It's the balance sheet, it's the valuation, and then you have to have one of the two other things: either good business, which is high return on capital, or a good management team, which means that they know they have to maximize value by selling, cutting costs, asset allocation of dispositions, or spinoffs, or whatever. And usually what happens when you have a good business that has a decent return on capital, that is undermanaged and it shows up in the lower margins, and there's no letter stock involved and no poison pill involved, that will be targeted by an activist pretty quickly. The market is that efficient. And hopefully you'll have your position beforehand. That happened more often before, and it happened in software a lot back, 15, 20 years ago. There were times, and it hasn't happened in a long time, since 2011 or 2015. But before, in the 2000s, you could buy software companies at 2 times revenue with clean balance sheets. And so those were the good times. So not so much in the last 8 years.
Tell me about the valuation. You keep talking about valuation. How do you value companies?
Well, there's 2 things I take into consideration. The net cash, or the balance sheet first, which is easy. Okay. Do they have extra assets? Are they overfunded in their working capital? Do they have more cash than they need? You deduct that from the valuation. Or if it's a liability, do they have, debt and pension and, contingent liabilities? you add that to the enterprise value. So it's not just the market cap. You have to make adjustments for that market cap. Because if you were to take over the whole company, it's like buying a house. If you bought a house that for $100, but they left a safe with $10 of gold in the living room, well, you bought that house really for $90 because you can take that gold and safe and sell it on, whatever. If you bought that house, a month later after you own it, there's a hole in the roof and you got to get a new roof that costs you $10. Well, you didn't buy it for $100. You bought it for $110. And the businesses are the same. So, so that's one thing, and it's very important. And then it's the valuation. So, we're trying to buy things at 8 times normalized EBIT. Again, the EBIT is probably not exactly obvious at that point in time, or not believable, not credible, because, that's why people are selling it down. And, hopefully you ride that 8 times EBIT. And that EBIT grows over 2 years. So if it's earning 100, in 2 years, it's earning 115. So we bought that 8 times. Let's say the balance sheet's flat, no debt, no net cash. That business is earning $100. Okay. And that's going to be, we bought that at $800, 8 times EBIT. Okay. But let's say in 2 years, they fix whatever business problem they have. They go back to the origin of the mean plus the natural growth of the economy. That EBIT becomes 120, and we get a multiple, and then we sell it at 12 times EBIT or 13 times EBIT, because if you tax effect 12 or 13 times EBIT, that's 16 times net income, which is the normal S&P average over a very long period of time. So that's the average business. And so if you multiply, let's say 12 times 120, that's 144, right? But you bought that at 80 in year 1. Now it's 144 in year 2 or 3. You went from 80 to 144. That's your return, which is like, I don't know, like a 25, 30% return a year. So that's what we generally do.
EBIT, you don't use it across all the industries, right? Or you do?
Industrials, service companies, software companies. Obviously, you don't use it in financials.
Mm-hmm.
So, but I don't think I've ever owned a steel company. I don't own a lot of retailers. I don't own a lot of restaurants in general. Occasionally, but not me. It's a subsidiary of some company that I own.
Let's talk about industrials, for example. So industrials have a bunch of capex, right?
Yeah.
So what's your take on thinking of EBITDA minus capex?
As long as you're consistent, that's a fine proxy for EBIT. If you're, because there is 2 different type of capex. There's the maintenance capex, which is, to replace the parts that you need to just keep a steady state business plus inflation. And then there's investment capex, which is like, okay, what's your incremental return on that additional store or additional plant or additional highway? And so those are, not all capex is exactly the same. But yeah, as long as you're consistent, it doesn't matter what level you use, revenue, EBITDA, EBIT. Those are just cheap benchmarks that you can get to something very quickly. It's not, what ultimately matters is, of course, free cash flow delivered to you at the end of the day. So in terms of dividends or market appreciation, and you sell a security.
So EBIT obviously takes care of the problem of dilution and stock-based comp. What's your take on stock-based comp? Is it a real expense or it's just a...
Well, it's a gray area. If you want to be ultra conservative, then you say it's a real expense and the GAAP accounting is correct. I'm a little bit more liberal in the sense because it is real cash. It does show up at the bottom line, not in the GAAP line, but in the economic line. It's a shareholder cost. And I know it's controversial, and I'm not the most hard opinion on that. It's definitely, not earnings, but it's definitely cash still. It's not really that important to me in terms of, well, obviously, if it's like 10% a year, then that's a big thing. If it's like 1 or 2%, that's the cost of doing business as a shareholder. What is more important to me is what drives those incentives long term, that they're forced to own the stock through ownership guidelines. But I can't tell you how many I own oil. Okay. And let me tell you, it's really disappointing reading those proxies because they're all measured by EBITDA. What kind of brain dead board of directors let their executives get away with that? And that's an indictment on me because I own those companies, because they're cheap. And, I guess I'm just way too bullish in oil, but they're all measured by EBITDA, not return on capital, And you can abuse that EBITDA number so easily by doing acquisitions. You get paid and the shareholders get, shafted with a heavily debt burdened company, or heavily diluted. It's just, all I'm praying is for high oil so I can get rid of these companies with bad compensation.
Do you run the concentrated portfolio or you're diversifying significantly?
It's not that scientific. And because, I own Google since 2008, it's 15% of the fund and I've sold a lot of it. So it did get big. It's still big now. And it is a concern. If I sell it, there's a huge tax bill, not only the current taxes for that year, but the estimated taxes for next year. So for all practical purposes, I have to pay 30% to the government next year and then take out another 30% of the proceeds out of the fund to give the government a free loan over estimated taxes. And so if Google's trading at 130 and I sold it, I'm only keeping probably 40 or 50 bucks to reinvest. So that's a real issue in terms of capital allocation. And the difference between me managing family office, which is it's a lot of my own money. Every single dollar, either I benefit or someone that I care for benefits from. So I'm very acutely aware of those things. But the big advantage is I don't have to worry about what other people think. Because most portfolio managers are not going to they can't survive an investment committee meeting looking foolish if Google, which I have at 15%, did what Meta did last year, going from 300 down to 90. That would not work I have a position in Meta, and I did ride that from 300 to 90. And if I was in front of an investment committee, I would look pretty foolish for about 15 months. That's the big advantage.
Google is 15%, right? So
yes.
At what point do you get a little uncomfortable with the position?
When AI can disrupt the business, basically. So I don't know the answer to that because, okay, if you tell me Google so let's say it's 130, they have $10 of cash, they have $10 of Waymo and cloud, and they're going to earn another $6 of cash this year, and then they're going to earn $8.50 next year. Again, this is pre-ESOs. So why am I selling that at $110? Even less if let's say if I sold 130, I only keep 70% of that. So that's like $100. Where can I use that $100 that's better than buying $8? That's the question right. So I don't know the answer to that. It's a debate that I've had every day for the last 15 years. So, I mean, if the stock was at 180, yeah, I already have a plan. Sell it down. By then it'll be like, I don't know, like 17% of the portfolio. Sell 7%, bite the bullet, and hope for some kind of market slowdown and redeploy the capital and other things. Because you just don't know when the opportunities are going to come up. Like one of your companies misses, or there's some kind of stupid lawsuit that happens, and the stock's down 20%. And you don't, one thing that's different now than it was 20 years ago, you don't have that much time to react. Mm-hmm. You only have 1 or 2 days before people figure it out. So it's kind of interesting now, and it's much harder. It's much harder now than before.
So, if you take Google out of picture and think of it quantitatively, you don't have this magic number of how much concentration you want to have to your names, right?
No, not really. I mean, part of it's the way I've structured it. It's like all my money is sitting in a checking account or T-bills at this point. The money I'm making or losing is for my kids or a 501c3, and they haven't. Trust me, my kid just walked out of the door today. Yeah. It's like, I love my kids, but let's be honest, they haven't earned any of it. And they deserve it more than anyone else, but they haven't earned any of it. And, 501c3s is as good as you think that you're doing. They're obviously, issues of self-interest with 501c3s also. As a value investor, the difficulty of giving out money is that you're used to measuring effectiveness as an investor because you're very rational. It's very different when you give out money. It's very hard to be when you're an investor, you're a sharpshooter. You're looking at particular, financial metrics, valuation, balance sheet. When you're giving out money, it's just much more like a grenade. You're just tossing it and hoping it has some kind of effect, but you're not sure.
How much cash you typically keep on your portfolio?
Usually, historically, 10 to 85, but I'm at 90 now. I mean, 90% invested. And that's just because everything's moved up. And they've moved up and the market's not cheap, but my stocks are still pretty cheap. So, I mean, Amazon at 140, you do a sum of the parts, I'm getting like 180 at 200 in a couple of years. So that's kind of hard to sell, especially with that barrier to entry with the GMV business. Google, I think it's worth, ironically, it's also worth 180 to 200. So Amazon could be worth, I don't know, 400 or mid 400s in a couple of years. So it's kind of tough to sell, but I'll sell a little bit over. And, sometimes I'll sell call options against it just to peel off some things and things like that, but still get paid a premium. If it doesn't hit the strike price, then, I earned a little bit of income. It's not a lot, but again, every $1,000 trade, even the $1,000 trade benefits someone in the family.
You said you rode Meta from 300 down to wherever they went.
90.
Yeah. And how much did you add, if anything?
I added some at 140. I added some at 90. Don't think I'm a hero. I bought 500 shares at 90.
Yeah.
Maybe 1,000 if you look at my other accounts, but maybe 1,500. But certainly I wasn't that brave. I was just like, well, this is ridiculous at 120. So I bought like 1,000 shares. This is ridiculous at 100. But my confidence is my confidence. I mean, I'm not telling you I'm strong because it's like, it's not easy losing money. There is a lot of suffering and there's a lot of self-doubt. So instead of 1,000 at 120, 120, if you bought 1,000 at 120 and it goes to 100, logically you should buy up 1,500. No, this is just my weakness. I'm buying like 700, 800 because I still think I'm right, but just in case I'm wrong, I don't want that much more. And then it goes to 800, $90, and I'm sitting there. Well, I'm going to just buy some. I'll buy 500 shares, or I think I bought it like across my accounts, like 1,000, maybe 1,500 shares. But it didn't last long. But at 80 was ridiculous. It was like, there was like, I don't know, $10. I think also like 10, $12 of cash. There was the value of WhatsApp, which is probably worth like $10, which is, I think it has to be one of the most underutilized. I don't understand why. It's just me. I'm not a techie. Why the heck did he go into, I understand why he went into, Oculus. It makes sense. Okay. He doesn't want to be behind iOS and Android anymore. He wants to be the operating system. And it's a long moonshot bet, but I get it. I respect that decision, even though it's very costly. It probably won't work, but I still respect the decision. What I understand is like, why hasn't WhatsApp become WeChat of America? It's like, why isn't it the main shopping channel? I know he's trying. I know it's worked in Brazil and India, but it's an underutilized asset here. I just don't, I'm not that savvy in terms of how these things actually work to figure it out. But it just seems to me that much easier business segment to build than the Oculus business. So but if you add that all buck, it's like you're buying a core business at $60. And if you added back the losses from the Oculus business and the stock options or the RSUs, they were earning like $20 of free cash flow. So that core business you were buying at 3 times, that core Instagram, Facebook business you were buying at 3 times earnings. And it's like, well, it was pretty obvious. And I think I got this from Strategery that they were going to use AI for targeting and keeping you engaged longer. So it was just a matter of time. So that's the bet I took. And I guess the big thing was just not selling it all the way down. That was helpful. So I'm kind of stubborn on that way. I don't sell just because it's going down. I sell because the value is not there anymore.
What's the latest stock you bought?
Well, it's something that I've owned off and on is U-Haul. And when it gets up in price, I sell some. I always keep some, but I will, anywhere between 1% and 5%. And U-Haul is like, it's the perfect long-term crotchety management, family-owned business that they like to delay gratification. They like to underprice their services and products. It's like how I would think I would like to run a business. Just, give the customer good value and still have a decent return on capital, and things will take care of itself. U-Haul is it's really three different businesses, and one of the businesses wasn't really a business until interest rates went up. But it's the self-moving business, which is obviously taken on the chin because no one wants to give up their 2.9% interest rate on their house to move into a 7% interest rate house. So there's less moving, just like there was more moving during the pandemic. There's less moving now. And so that's for 1 day, like a 1 or 2 day period, not this earnings release, but back in May, the stock went from the mid 50s to the high 40s, and I stepped in and bought then. Again, it didn't last long. It only lasted 1 or 2 days, and then it stabilized around the 47 area, and then it slowly moved up back to the mid 50 area. And they just reported yesterday or the day before, and I was hoping that they would miss it again and the stock would go into the 30s. But then I guess people look through and they're willing to suffer through the slowdown in moving. The other business is the self-storage business, which it's not a great return on capital business, but it's just very steady. Obviously, if you're following the space, you saw the Wall Street Journal article last week about self-storage and overbuildment. But it seems to me that if you're overbuilt in one area, let's say if you have a lot of let's say if you're not just U-Haul, but one of these major self-stores, like public storage, and you have a bunch of people building near you, like a bunch of mom and pops who are not particularly well capitalized, well, you just lower your prices for a quarter or two until they default on their debt and you take over that facility. I mean, it was a good article, but I think that there was no one there to respond to that and say, well, there have been recessions before, and I think there's folklore at U-Haul that they have a life insurance company. And when there was I forgot what year it was, maybe 2008 or whatever, the last great financial crisis, that Joe Schoen used his life insurance portfolio to go buy the bonds of junk storage facilities because he could always renegotiate or reorganize the thing as senior capital or some capital owner. And so he knew about the business and he took advantage of that.
Wow.
So,
that's smart.
Yeah, no, that guy is crusty.
That's smart.
He's definitely, let's just say, colorful past. I'm not going to say what happened in past. You can go Google that. It's a colorful past. But in terms of the type of managers I like people who want to give the extra dollar back to the customer, because that's the best form of business in the long run. As long as you're making a decent return. It's like the Costco method. The Costco method is like, keep your employees first. Everyone loves going to Costco because they'll drive 7 miles to save a nickel. It doesn't make any sense, but it makes you feel good. And then, whatever's left over, the shareholders will win. And so slowly but surely, I mean, the self-moving business is not going to grow that much. But it's impossible to replace that network. Penske, Enterprise, they just don't have the bandwidth to replace it. They don't have all those locations. Those locations are amazing. Just a lot of them. And then, the self-storage business, the other business I want to mention is they have a PC business and a life insurance business. And that's just an afterthought most years. The PC business is actually not a big business, but it's a captured business. Because when you rent a truck from U-Haul, that's not like you can use your credit card insurance company or your home auto. That's a specialized vehicle, which you have to buy the insurance from a specialized insurance company, which U-Haul has. Not only that, the float finally has value. So when you can get like a 5% easy interest rate now, then that's all of a sudden, real money. That's like, you guys can look up the balance sheet and you can see how much float they have. And it's significant if they revalue all of that to like 5% interest rates or 6% interest rates or 6% return on assets. So, which I don't think is that hard to do. Conservative portfolio.
I had no idea that U-Haul was such a good business, frankly.
Oh, no, it's one of the best businesses around. No one follows it. It's always like in Barron's every 1 or 2 years. And they always say how good it is. But it's like how do you replace that self-moving network? I don't know. I don't think I could. And I don't think the smartest guy at Harvard MBA school or Stanford MBA school could do it. It's not going to be Amazoned out. people are always going to move and they're always going to want to save money. That's what self-move is. Now, again, it's not going to grow that much, or it's not a high grower, but it's not going to disappear in 50 years. And self-storage, it's a decent business. It's not a great return on capital business, but I'm not saying they're ever going to do this because they're family owned. But if you just would spin out that self-storage business and got a management company like what Coke did to Coca-Cola Ballers, wow, whoever owns that stock at that time is going to have a happy morning.
So why are you trading in and out of position instead of holding it for?
Because it hits my fair value, and or it hits closer to my fair value, and I have something else I want to buy. But yeah, I mean, if you want to be lazy, just own it. But it trades. It will float between mid 40s to high 70s, 80s. My fair value is like in a couple of years is high 80s. So if you told me I can sell today at 70, I probably wouldn't redeploy it or wait until the next correction and the next wave of volatility.
Interesting. So you rather not hold it all forever. It just that's where the typical range is.
Well, no, I always want to be involved because I like that management team. But I'm not saying I want to be involved at 5% of my net worth. I'm definitely one. Right? There's just certain management teams you like.
I see. Like, how do you value this business? Is it also EV to EBIT?
No. You do the sum of the parts.
Mm-hmm.
So you have to break down what the actual economics are for. For the self-moving business, I suspect that they're reinvesting at the business at a higher rate because their margins are not that high for something that's a monopoly. You would think they were higher margins than self-moving. Self-storage, you just break it down. It's like you comp it with the other publicly held storage companies, but it's like, I'm just making these numbers up. It's like $15 a year per foot in revenue. And then they pay $1 for taxes, $1 for maintenance, and $1 for management. And they're left with like, I don't know, 10 or 11 bucks. It's it's a 70% margin business. You value it on, how much each square foot is. And if you put a multiple on it, like $11 EBIT and say it's worth 20 times after tax earnings, that's a 16 EBIT number. So you put the self-storage 16 times. I think, again, that self-moving is underreported in terms of what their real margins are. It's hard to get a good comp, like maybe rental equipment from United or something like that. But they should be running that like a 20% margin business, and they're reporting much lower. So I use a 2.2 multiple for that. Maybe what am I using? The model up here, 2.5 multiple for that. Mm-hmm. Then the insurance, which didn't have a lot of value before, but now has potentially a lot of investment income. You can use a rather high investment multiple for that, maybe like 12, 13 times that. But they have corporate expenses and they have a heavy balance sheet because they do have debt for the self-storage and probably some of the rental equipment too. So you obviously have to take value out of that. So you have self-storage, you have self-moving, you have a little bit of underwriting profit from the PC business, a little bit of an underwriting loss from the life business. You have the investment income, you have interest expense, and then you have to multiply you have to put some kind of negative value for the corporate expenses, and then sum them up and divide by 196 million shares.
How do you assess management?
In general or at U-Haul?
In general.
I invest in bad managers sometimes, if the business is cheap enough. But there are clearly times when there are better managers than others. And you can tell that from reading their annual letter, if they're giving you the numbers that you would respect, like return on capital and things like that. That's very rare.
Yep.
I mean, most of these managers, quite frankly, are always going to justify whatever they're going to do to make sure that they have the highest currency in terms of their wallet and their image. That's just self-interest. And that's what I expect them to do. I own this oil company that is not a good business, that has a compensation system that I don't respect. That's not intellectually honest. And then when oil turned negative, and I rode the stock from 27 down to 1. But at $1, they had net cash and they had an NOL. If they executed, at that point in time, if it was a going concern, then it had a negative EV, negative enterprise value because of the cash and NOL. But if they go bankrupt, then the NOL is basically worthless. And so I rode the stock from 29 down to 1, and I think the stock is currently trading in the $11 area.
How do you incorporate NOL in the valuation? Can you walk me through that?
Well, you take the deferred tax asset, and then this is just me.
Mhm.
I just half it. It's so long in a time series, and just half it and add that back. You got to be careful because you got to look in the footnotes, because sometimes it doesn't show up on the balance sheet. It shows up as the valuation allowance in the footnote, and then I just take half of it. So if it says it's $100 million, let's say on the balance sheet there's no deferred tax asset, then you go look at the footnote and there's $100 million deferred tax asset, but there's $100 million valuation allowance behind that. Well, I'll say, well, that $100 million is probably worth $50 million.
Why?
But just because of the time series, because it lasts so long. So it's just like a cheap way of doing NPV on the NOL, that present value. I don't know. So then I put that in the enterprise value.
Got it.
Or take it out of the enterprise value. But it's still a little tricky. It's like, it's an opinion. Is this thing going to concern? Is it going to be able to recover all of its losses that are on the tax loss book in the right time frame?
So some people who invest in high growth companies, especially in the SaaS field, right? Those are losing money all the time.
Yeah, but mine are even worse.
Oh yeah, yeah,
worse. So imagine owning Rolls-Royce after the pandemic. Man, that's a huge NOL. Or yeah, they could get bad.
Rolls-Royce is an interesting company, and I remember Sequoia that not Silicon Valley Sequoia, but the
Wayne Kniff.
Yeah, they used to own it for a long time.
Yes. Well, unfortunately, I believed, flatten the curve in 2 weeks. Well, what an idiot I am. Never going to believe the government. So I was too optimistic there. And so I bought it right in the mouth of the pandemic, thinking, oh, this is just a short-term thing. And promptly lost like 70 to 80% of my capital, the rights offering. It was awful. Just every day was just more bad news. And then I was looking at it last summer, and I said, well, it's tricky accounting, right? Because the GAAP earnings are actually kind of meaningless there, because of the way the cash economics work is like, what shows up of a liability really shows up as free cash flow. And they had 2 subsidiaries, the small nuclear reacting business and the self-flying taxi business, these 8-blade type vehicles that fly in the sky. The whole thing had an enterprise value of like $10 billion. And if you took the debt out, add the debt back to the enterprise value, then took out these 2 subsidiaries, and the remaining, they have defense and a turbine business, right? Then you were buying like $8 billion. The enterprise value at the time was $8 billion, and they were going to have like $14-15 billion pounds of revenue. And these businesses, through experience, businesses like these, all those 3 businesses should have like at least 10-12% EBIT margins. Mm-hmm. So this company should be worth at least $16-17 billion in enterprise value, if not more. And so, even though I had lost a ton of money, I never sold a share and just tripled down. It wasn't that hard to do in terms of shares because it was trading below 1, and my average cost was like 7 or 8. I think I 3 or 4 times my shares, and obviously it's worked out in the last year. And the other thing is like, okay, China's going to come back sometime. People are going to fly to China sometime. I don't know when, but I know they probably will, and they don't have a weakened balance sheet. Their balance sheet is not as much of a problem anymore. Assuming that there's no other pandemic or mass industry-wide disruption.
People who are not following the company probably confused, like, wait, which Rolls-Royce he's talking about? The car?
Yeah, not the car company. The wide body, only wide body. So it has to be like a 747 or I think a 787. So those planes with 2 aisles that you take for long haul flights. So it's kind of a specialized market.
You talked about cover calls.
Yes.
And you actually, in this conversation, you mentioned that it's one of the exit strategies.
Well, it's not, it's something that I just taken up recently, actually. And it's not for a lot, but it's like, okay, take, for example, Google. Well, I wouldn't sell a cover call at Google at 100, but, the day before it started at 120, and then they had a good earnings, which they do about 3 out of 4 times. Then the 4th time, it's some kind of dud and the stock goes down. And the stock goes from 120 to 130 at one day. Well, I'll sell a call at 160, collect 80 cents, whatever. right? Not for the whole thing, but for 10,000 shares, whatever. Because at 160, you know what? I'm willing to sell 10,000 shares or 10% of my position. Okay, so that's the key thing. I'm willing to sell it if it gets executed at 160.
Mm.
And then, I make sure it expires before the next earnings, so I don't have to worry about that volatility. But what happens, and this is not scientific, this is just my guess, that day after earnings, the volatility is higher than normal because people are making their bets. They're happy that they made some money. So people like the fact that Google has more momentum now. So the volatility, and when you sell calls, you're just selling volatility. So maybe you get a little extra juice that way.
Mm-hmm.
So I don't sell calls unless they're at fair value or unless I'm willing to sell the stock naturally at that price. So it's just found money as far as I'm concerned. The other time I'll do it, and this has been incorporated since the beginning. Let's say I buy a stock and I buy it for 70 cents. It's worth $1. And immediately, like within 8 months, it goes to like 95 cents. Okay. I don't want to sell it yet because that's short-term gain. So what I'll do is I'll sell an option with a strike price, with an expiration that if the stock was called away from me, that'd be a long-term gain, not a short-term gain. You don't want your shares called away from you and you realize a short-term gain. You only want to realize long-term gains.
Elaborate on that a little bit. Elaborate on the dates. So let's say.
Okay, so let's say you bought a stock on January 1st.
Yeah.
Okay. And let's say it's after earnings and it's October 20th the following year. So like 10 months plus. So you're still 2.5 months away from going long term. And let's say it's 95% of your fair value.
Yeah.
Okay. What you thought it would be worth. Well, you don't want to sell it 10.5 months in because you have to pay a lot of extra taxes. So you sell a call option that expires on January 2nd.
Mm-hmm.
Okay. Sense. Let's say it's trading at 95. Well, you sell it at 97. So you're out of the money. You're not convoluting any rules of like realizing that your gain is short term. So you review it with your tax account and stuff like that. So I'm not a tax guy, but that's how I understand it. So if you did sell it, you'd sell it at 97. You're not crossing over any lines in terms of recognizing income. And you're selling it on January 2nd, not December 31st. You sell on December 31st, that's a short-term gain. You sell on January 2nd, that's a long-term gain because you bought it on January 1st of last year. So you collect a little bit of money. If it goes down, you didn't lose any, you still got the consolation prize. And it works the other way. Like imagine if you sold a put option on Meta at 80 or 90, like last November, and you went out a couple of years, you sold a put that expires in 2025, November 2025. So you have 2 years of earnings, which is probably like another $15. Then let's say you sold it at like $60. So the stock's at 90, you sold the Meta put at 60. So your strike price is 60. You get $1 or $2 from that. But you're not buying at $60, you're buying at 58. Okay. And Meta at that point in time is not going to have $12 of cash. It's going to have $17 of cash. And then you still have the Oculus business and the WhatsApp business worth $10 a share. So you add all that back up again, then you're really buying the business not at $58, but I don't know, 25 minus 58, which is what, 33? Should have like $22 worth of core business earnings or $23. That's pretty compelling. It's hard to lose. That's a lot of margin of safety there. Now your upside is limited to that premium, but I'm just saying, it maybe not, and you do lock up your capital. Well, my point is you don't put an option bet down. First of all, I'm never buying the options. I'm never buying a put or buying a call. I don't like paying premiums, right? I'm just cheap like that. I'm always selling premiums. Hopefully premiums, that are heightened volatility because there's some kind of disappointment or excitement. Excitement on the call side, disappointment on the put side. The trick is whatever, you put it at a strike price where you wouldn't mind owning that stock or you wouldn't mind selling that stock. Call options, you wouldn't mind selling it at that point in time because it's close to fair value and it's long term. The put option is, you wouldn't mind owning that stock in time. Like I've never owned bookings, but I've sold puts on it like 2 or 3 times back in the pandemic. And recently, I don't know, sometime in the last like 6 months, they had a disappointment and stock got cheap. So, but I never actually owned the stock.
But for selling puts, you need to have cash then to buy it.
Yeah.
Versus
I always have money.
Yeah, but for calls versus calls, you already own the stock, so it's kind
Right.
of
Right. So yeah,
less risky.
you have to set aside the capital.
So let's
Like if you're always going to have T-bills, right? Then that's the capital.
So let's talk about writing calls a little bit more. So what type of premium do you get?
Not much. Like usually, like if you look at it, the current stock price versus the premium, I'm getting like a 1 or 2% annualized. No, 4 or 5% annualized return.
Not bad.
1% at that for that particular option, but you do it for 4 quarters, you get like 4 or 5%. It's really powerful. It's not that powerful in the LP because obviously options are short term and that's a heavy tax. It's powerful if you can do it in your 501c3 and your IRA, which there's no tax effect.
Okay,
because they're tax free.
So question here. So who can do it? Like anyone with a Schwab accounts, they can do it too?
You can do it in your IRA. If you can't sell naked calls, you can do it in your IRA as covered calls. Anyone with a Schwab account or Fidelity.
Interesting.
Interestingly enough, they let me do it in my 501c3 account recently too.
How's that premium that you get taxed?
Because they're tax-free accounts.
No. If it's like doing for Schwab, for instance, right?
Yeah.
How is it done? Like, so is it? It's not a gain, but what is it like? Is it just
it's a gain. It's a gain. Yeah.
So it's gonna be
they're in tax-free accounts. So.
Yeah. What I'm saying is like for people who are gonna do it like on the Schwab accounts, not tax-free, right? Like if somebody wants to do it on the brokerage that's not tax-free, not IRA or anything.
Well, then you're just gonna have to pay the short-term gains.
It's a short-term gain. That's what I was curious about. Got it. So one of the things with value investors, and Buffett always talks about it, investors in general, it's very heavy on reading. And you have dyslexia.
Yes.
How do you reconcile the fact that you need to read a lot and your dyslexia, and that you perform quite well?
Right.
Like I remember your track record. I was like, holy shit, he's just killing it.
Yeah. Well, thank you.
But how do you reconcile all these things?
That's one of the reasons why I worked for myself and never worked in the corporate world, because I knew I couldn't survive in the corporate world. I knew that my skills weren't set for that type of environment. Interestingly enough, most dyslexics end up working for themselves or just wash out of society. But like Malcolm Gladwell said, it just heightens your other abilities. And so, my dyslexia is like I can't really tell my right from my left, and I can't really spell. But my reading comprehension is great. So it wasn't that severe. But, modern technology, I mean, when I started in the business in 92, you would have to call a company and ask them to send the 10Q to you and put them on the mailing list. And then you would have this room of all these filing cabinets with all these years of 10Qs. And that's how you did your research. Well, you fast forward to 98, I was really lucky because in many ways I was really lucky. But one of the things I was lucky in is that was the first time you can get a T1 line into an office, and you can get your SEC documents very quickly. Okay. And so, fast forward, another 25 years. Well, I don't have to read the Wall Street Journal Barron's anymore. I just listen at 2 times speed while I'm doing my dishes or getting my steps in.
Yeah.
Right. Well, not Barron's because their technology could be better, but you can listen to 1 time speed. But like, Wall Street Journal, you can listen to your 20, 30 articles a day, get your 10,000 steps in, kill 2 birds with 1 stone. Podcasts are great. YouTube, if you want to learn what Tencent does, go look at YouTube. There's like 30, business model breakdowns of Tencent. You go on podcasts, they break it down. You find it on Twitter, who's following it, who has some insights. I mean, the breakdown in terms of research and Scuttlebutt, Sinking Alpha, Morningstar. If you are motivated, there's no reason why you can't understand a business pretty quickly, like within 1 or 2 days, between all the great podcasts and free or fairly cheap, sources of information. And you may not agree with it. And if you don't agree with it and have a different thesis, that means you know your stuff. Or there could be things, well, I didn't think about that. And then, you have to question whether you're right or not.
Last time we spoke, you said an interesting thing, and you actually sent me an email about it. It's about the happy life things and general philosophy of life. Like, what's your philosophy of life?
First, I'm a big Ayn Rand devotee. And I read that 15 years ago for the first time, right after Obama got in office. And I said, this was written about in 57. And that spoke to me. And, I'll sum it up to this. It's like, if you're lucky, you're given 30,000 days on Earth. Okay. That's an 80 year life. Okay. So if you think about it, if the average baseball stadium fits 40,000 people, you're going to sit in 75% of those seats. And some of the seats are going to be behind home plate, and some of them are going to be in right field up a tier. So not every day is going to be a good day. But the purpose of life is to be happy. Okay. It's not to like think the world's going to end because there's climate change or whatever. Be happy. Okay. The best way to be happy, and I got this from Scott Adams, the guy who wrote Dilbert, who was recently canceled, but he has a podcast, that the secret to being happy is having freedom plus health. Health is about exercise, obviously, watching what you eat, non-processed foods, fresh foods, more vegetables than meat, and then obviously exercise, but also, having a community, having a church, having friends, sports. Like I think chasing a ball is a two-for. Obviously, when you're young, one of the greatest joys that you don't know you missed until it's much later is just the simple pleasure of chasing a ball with friends. The longer you can do that, the wealthier you'll be. You'll be happy. Okay. Because it's friends, and plus you're keeping your health, and plus you're playing outside. You get the vitamin D, which is good for your immunity system. It's a natural exercise. Fresh air and the sun are just natural antidepressants, in my opinion. Although I'm not a doctor, it just seems that way. Okay. The other equation is freedom, right? The ability to choose who you work for, who you work with, when you want to work. And so, like, I don't understand these medical school students who graduate with $400,000 of non-dischargeable debt. These are some of the smartest people who worked incredibly hard to go through 8 years of school, 4 years of residency, maybe fellowship, and they have $400,000 of debt, which is not dischargeable. So just the interest on that, let's call it 7%, is $28,000 a year. Well, that's after-tax money. You got to earn $40,000 a year just to pay that interest to service that debt. And that's not even paying back the loan itself. Well, think about what you have to give up. You can't buy a house until you clean up that debt. You have to take any job. You can't choose where you want to work or who you want to work with. So those guys worked incredibly hard to have the chains of student debt on you. Well, that's not freedom. And if you're not free, you're not going to be happy. They're going to have less availability to be happy because everything's going to be delayed in terms of household formation and stuff like that. And so the ability to have choice will give you more options to be happy. And I do want to say that there is a big difference between wealth and making money. You could make $1 million a year, but if you have $1.2 million in expenses, you are the opposite of wealthy. You are insolvent eventually. But if you make $100,000 a year and you only spend 80 and you're saving 20, well, who cares? You're happy. You're solvent, right? No one's going to be knocking on your door, taking away your house. No one's going to be repossessing your way of traveling by repossessing your car. It's much easier to be free and happy if you enjoy leftovers and used cars versus eating at fancy restaurants and buying 6-figure cars. The other thing I would say about being wealthy, if you solve problems, you will be wealthy. When you solve your own problems, you become an adult. Okay, I can figure out how to get a bank account and pay my bills and buy my home and stuff like that. When you solve other people's problems, you become loved. And I got that from Oprah Winfrey, from Eleanor Roosevelt. You have to figure out anytime you walk into a room, how to be helpful. Ideally, over time, you figure out whatever situation you're in. How do I make this person money? How do I save this person money? Or how do I save this person time? Because if you're not doing those three things, you'll get away with it for a decade or something. You can hide wherever you want in some big corporation. But at the time you roll around that you're 50 years old, if that company or that industry is hitting a crisis and they need to restructure, you're at serious vulnerability in terms of losing your livelihood. So you better incorporate the mentality, whatever place I'm in, I'm going to try to figure out the currency of this place. And usually the currency is saving someone money or making someone money. I don't have LPs, but I'm really loved in my family because I made them a lot of money. I gave them their freedom. I have a brother who has a cardiology degree, no debt at all.
I actually want to tell you, like, don't you have a medical degree, brother?
Yes, yeah, he's a cardiologist, and he has no debt. He'll go nameless because I don't want people to target him, but and he can choose whatever job he wants in terms of cardiology and say, hey, you don't have to pay me X amount of money. I'll take $50,000 to work here because I like you guys, or I want to learn from you guys, or something like that. It's incredible amount of freedom. Or I don't like the hours here, so I'll go work there. Or I don't like the weather here, I'll go work there. You can't do that if you have $400,000 in debt. You have to go work in some rural doctor area. That's not going to make the people around you very happy. Every situation you should be walking is like, how can I help this situation be more helpful? I mean, or better, save someone time, help clean up, help set up, whatever.
That's a great advice. And
Yeah.
James, that's thank you very much for being on the podcast. It was great.